Welcome to Talk Tickers. We're your essential briefing on the latest earnings calls. Our goal is always to get you informed quickly and really thinking critically about what matters in these calls. Today we're doing a deep dive into Integer Holdings Corporation, that's ticker ITGR. We're looking at their second quarter 2025 performance. It's a really interesting picture, actually. A medical device company navigating some big strategic shifts and, well, market expectations. So Integer reported what felt like a bit of a mixed bag for Q2 2025, left investors with, plenty to chew on. On the top line, the revenue number was $476 million.
Yeah, that was solid.
Definitely solid. Handily beat the consensus estimate, which was around $464.4 million. And that marks an impressive 11.4% increase year over year. That kind of growth, you got to notice that.
You really do. 11% is strong. But the market always looks at both sides, right? And on the bottom line, the adjusted EPS, that came in just a tiny bit below expectations, or $1.55.
Right. Consensus was $1.57, so just 2 cents shy?
Exactly. Just a couple of cents. Management, they put a positive spin on it, called it another strong quarter, highlighted strong sales, operating income, adjusted EPS growth. Yeah, of course. But the immediate market reaction, pretty cautious. Even with that strong revenue beat, it kind of hints that investors were maybe looking for something beyond just the headlines.
Yeah, you can say that again. A big revenue beat usually gets people excited, so that caution definitely makes you want to, unpack things. Let's peel back the layers here, dive into the specifics of Integer's quarter. There's clearly more going on than just those two main numbers.
Absolutely. When you dig a bit deeper, you see the GAAP EPS, that's the generally accepted accounting principles number from continuing operations, was $1 rate of 4 cents. Adjusted EBITDA, which, gives you a sense of operating performance before certain costs, that grew a solid 10% year over year, hit $99 million.
Okay, 10% is decent.
Yeah, and GAAP operating income was up 9% to $59 million. So, on the profitability side, things were generally moving in the right direction. Shows some underlying operational strength there.
What's really fascinating here, though, and investors always watch this closely, is the leverage. Their total debt stood at $1.2 billion. That pushed their leverage ratio to 3.2 times adjusted EBITDA. And, in this climate, debt gets scrutinized.
Oh, absolutely. Always. But management was quite clear on the call. They emphasized this is comfortably within their strategic target range, 2.5 to 3.5 times. So 3.2 is, inside that band. It's not like it's a runaway number.
Yeah.
They frame it as calculated, supporting their M&A strategy, their recent convertible note updates. They see it as a managed use of capital, really, funding growth, not just covering operations. It's that balance, right? Funding expansion while keeping some financial flexibility.
Okay. Now let's talk about the real standout. If you're looking for the blockbuster performance in this quarter for Integer, you absolutely have to look at Cardio and Vascular. That segment just shot the lights out, up an incredible 24% year over year.
Huge number.
It wasn't just good, it felt like a genuine acceleration. Really makes you ask, what exactly drove that kind of growth? Feels pretty pivotal.
It certainly does. And that impressive growth, it was mainly driven by a few key things. First, new product ramps in electrophysiology. That's, the heart's electrical activity. Big growing market for treating arrhythmias. They saw significant uptake there.
Right. EP is hot.
Definitely. Second, the contributions from those recent tuck-in acquisitions. Precision Coating and VSI Parylene, they played a crucial role. And these aren't just about adding revenue dollars, they're strategic. They deepen Integer's specialized coatings capabilities, super critical for these complex medical devices.
Okay, so adding tech.
Exactly. And finally, just robust demand in neurovascular, stuff affecting the brain's blood vessels. That also helped push the segment forward. So yeah, it really underscores Integer's deliberate strategic pivot, moving towards these higher growth, more specialized niches in medtech.
So it's more than just bolting on businesses. It's making the whole thing work better together. What does this pivot mean for their long-term advantage? Is it just revenue, or is there a deeper play here for you?
Oh, it's definitely a deeper play. Payman Khales, the incoming CEO, he put it really well on the call. It's not just adding revenue, it's about acquiring capabilities that compound.
Compound, how so?
It means each new acquisition, like Precision Coating, isn't just sitting there on its own. It enhances what they already offer. It makes Integer's whole package more valuable, more integrated for their OEM customers. It lets Integer move further up the value chain, right? Offer more comprehensive, more differentiated services.
Oh, okay. Like a one-stop shop.
Sort of. Imagine a device company needs this really specific coating for a tiny, complex part. Integer can now do that in-house. It makes those partnerships, stickier, harder for competitors to break in.
Sticky relationships. Makes sense.
Yeah, it fundamentally strengthens their competitive position because they're embedding themselves deeper into their customers' product cycles.
Okay, now in stark contrast to that soaring cardiovascular segment, CRM and neuromodulation, that saw much more modest growth. Only 2% for the quarter. That's a big difference in pace. How should we read that?
You're right. The difference is pretty notable. While growth in CRM, cardiac rhythm management, and neuromodulation was modest in Q2 and really the first half, management is actually quite optimistic for the second half.
Oh, really? They expect it to pick up?
Yeah, they're projecting mid-single-digit growth for the full year for this segment now. That's actually an increase from their prior outlook, which was low to mid-single digits.
Okay, why the optimism?
Well, it's largely due to strong growth they're seeing from what they call emerging PMA customers in neuromodulation. These are basically smaller, innovative companies. Their devices have FDA pre-market approval, PMA, so they've proven safety and effectiveness. Integer is partnering with them.
Gotcha. New tech coming online.
Exactly. Plus, just normalized CRM growth. Now, this positive outlook is partly offset by a planned decline in an older neuromodulation program. It's in its final year, being phased out. So yeah, while Q2 looked a bit soft, there's a forward-looking story here. A bit of a resurgence expected for this segment.
And then there's the other market segment. Declined significantly. Down, 38%?
Yeah, big drop.
At first glance, that looks pretty bad if you're just scanning the headlines. Is that trouble, or is there, a strategic reason behind that number?
You hit the nail on the head there. It's not trouble. It's actually a deliberate strategic move by the company. This decline is because Integer is actively exiting lower return, portable medical markets.
Shedding non-core stuff.
Precisely. They're consciously getting rid of parts of the business that don't really fit their high-growth, high-value strategic focus anymore. This whole process should be done by the end of 2025. And this exit is really key to improving their overall portfolio mix.
Right. Frees up resources, capital, people.
Exactly. Lets them focus on the more profitable, strategically important areas like that booming cardio and vascular segment we talked about. It's that classic short-term pain for long-term gain, pruning the portfolio.
Makes sense. Okay, with those segment results clear, let's look ahead. How does the management team see the rest of 2025 playing out? Because their updated full-year guidance had some interesting tweaks.
They did indeed, and this is interesting. Despite that mixed Q2, Integer actually raised the midpoint of its adjusted operating income and adjusted EPS outlook for the full year.
Raised profit guidance.
Yeah. That's a pretty strong signal of confidence in their underlying profitability and, operational efficiency. Adjusted operating income is now expected between $319 million and $331 million. Adjusted EPS between $6.25 and $6.51. So they're expecting margins to hold up or improve. Disciplined cost management.
But here's the curious part, right? Even after that strong Q2 revenue beat, they kept the midpoint of their full-year sales outlook the same. You'd think maybe they'd nudge that up too.
Yeah.
Why so conservative on sales, especially when they raise profit guidance?
Yeah, that's an important question. And it points to, I think, disciplined forecasting. Management explained it on the call. While Q2 was definitely strong, it was fueled not just by new products, but also by some customer demand shifting forward, pulling in orders from Q3, basically.
Borrow from the future effect.
Kind of, yeah. So as a result, the full-year sales outlook, $1.85 billion to $1.876 billion, that's 8-9% growth year over year, stays consistent. The main reason they gave is tougher year-over-year comparisons coming up in the second half, especially against what they called a very, very strong Q4 last year.
How strong was Q4 24?
11% growth, so a high bar to clear. They're basically setting a realistic target, expecting similar growth rates for Q3 and Q4 this year, around 8% year over year.
Okay.
So it's less about any underlying weakness, maybe more about managing expectations against that tough comp.
Got it. Disciplined forecasting, not a red flag. That makes sense. What about cash flow then? Is this operational strength showing up on the balance sheet? Cash is king, after all.
Absolutely. And yeah, cash flow looked pretty good. Cash flow from operations in Q2 was $44 million. Free cash flow, that's the cash left after reinvesting in the business, was $25 million. That's up 55% year over year.
Wow, 55% increase. That's significant.
It really is. Excellent improvement. And for the full year, they're projecting free cash flow between $120 million and $140 million. That midpoint represents a robust 30% year over year increase.
Okay, solid cash generation.
Yeah, it reflects their focus on manufacturing efficiency, operational improvements. That's vital, right? For self-funding growth and future M&A.
The earnings call also touched on inventory management and the tariff situation. Always hot topics, especially for global companies like Integer. What's the latest there?
Yeah, good points. On inventory, they gave some clarity.
Yeah.
Said the big OEM adjustments that started late last year have mostly normalized. The wild swings in customer orders have kind of settled down.
Okay, less volatility.
Right, but they did acknowledge, some demand variability still exists. Customers sometimes overstock, sometimes understock specific items based on their own forecasts, normal ebb and flow. What's reassuring, though, is Integer has a pretty substantial backlog, around $700 million.
$700 million backlog. That's good visibility.
Exactly. Provides clear visibility into future demand and lets them account for these inventory dynamics in their guidance. Suggests they've got a decent handle on the supply chain.
And tariffs. That's always looming. Big headwind for a company operating globally.
They actually expect a pretty negligible impact for 2025. They estimated it somewhere between $1 million and $5 million.
Oh, that's less than I might have guessed. How are they managing that?
They're actively working with customers on logistics, like shipping directly from their plants in Mexico to international spots, bypassing potential tariff issues. Plus, they're leveraging their existing contracts. 70% of their business is under multi-year agreements. That helps lock in terms, minimizes surprises.
Smart. Proactive management.
Yeah, it shows they're thinking ahead about managing those external economic pressures.
It also sounds like Integer is playing the long game, positioning itself strategically in emerging markets and future tech. Where are they finding those next growth pockets, the really sticky opportunities?
This is super crucial for their long-term story. They're smartly leveraging those specialty coatings we mentioned and the relationships with those emerging neuromodulation customers, the ones with the PMA approvals.
Right, the innovators.
Exactly. And in these areas, the CDMO contract development and manufacturing organization switching costs are incredibly high. Think about it. Once a med device company has Integer making a critical specialized component, moving that production is super expensive, time-consuming, risky.
Locks them in.
Pretty much. Creates those sticky customer relationships, locks in long-term revenue streams. Beyond that, they highlighted broad exposure in electrophysiology, including that fast-growing pulsed field ablation, or PFA, market, using electrical pulses for arrhythmias.
PFA is getting a lot of buzz.
It is. And they also mention exposure to the hypertension renal denervation space, RDN. That could be a big future driver, maybe 2026, 2027, especially if reimbursement improves, makes those treatments more accessible. So yeah, they're definitely planting seeds in high potential areas for the future, playing the long game. Okay,
let's pivot now to the market reaction, because this is where the story gets really interesting, maybe a bit confusing. The stock dropped. A notable 7.5% drop on significantly higher volume the day of the call.
Yeah, big move down.
That's a pretty stark response, isn't it?
Yeah.
Especially after beating on revenue and raising profit guidance. What does that tell us about investor sentiment right now?
It's a fascinating case study, really, in market psychology. It suggests maybe more than just a simple sell the news event. It feels like a stark reminder of the market's current, maybe obsession with short-term precision.
Precision meaning?
Meaning hitting every single metric exactly, even with strong revenue, clear strategic wins like C&V performance, that tiny miss on adjusted EPS, the slight uptick in leverage. It seems like that triggered an outsized reaction, almost punitive.
Punitive? That's strong.
Maybe, but look at the drop. The insight here is maybe how fragile sentiment can be and how it often prioritizes the immediate exact numbers over a compelling long-term strategic story. It implies the market has this incredibly high bar for flawless execution right now, punishing almost any deviation, however small.
So given the revenue beat, the raised profit guidance, couldn't you argue that market reaction was maybe an overreaction? Or perhaps just misunderstanding the long game?
You could absolutely make that case. While management was highlighting broad growth, better profitability, the market's focus just snapped to those couple of short-term metrics that fell short, even by pennies. And this focus led to Integer's stock underperforming the broader U.S. med devices ETF, IHI, over various timeframes recently. So what it tells us is, while that strategic pivot, higher growth cardio, neuro, the smart M&A for coatings, while that's clearly a long-term positive, the near-term investor focus is squarely on consistent, unequivocal execution.
No room for error.
Seems like it. That includes successfully integrating those acquisitions, ramping up the new products, managing the leverage vigilantly. Oh, and the addition of Michael Coyle to the board just before the call, that's usually seen as a positive, strengthening governance and expertise. But clearly, the market focused elsewhere on call day.
All right, let's shift gears to our wild yet plausible trade idea segment. Given everything we've discussed, Integer's market sentiment, the strategic moves, I'm eyeing something I'm calling a short the legacy, long the future play. The market's clearly penalizing that slight EPS miss, the leverage, while I think it's significantly underappreciating the strategic pivot.
Okay, short the legacy, long the future. Intriguing frame. Tell us more about the mechanics. How would that actually work?
So here's the pitch. We go long ITGR call options, thinking maybe expiring out in Q1 2026, and specifically targeting a strike price maybe 15% above where the stock is trading right now.
Okay, long calls, 15% out of the money, maybe 6-9 months out, betting on a rebound and then some.
Exactly. And look, the implied volatility right now after that drop, it might be a bit elevated, which if you really believe the market overreacted and the long-term story is intact, could actually make those calls relatively cheaper than they perhaps should be. It's a bet on a re-rating.
Right. And the wild part, the short, the legacy piece, how do you capture that side of the thesis?
Simultaneously, you might explore shorting a basket of smaller, undifferentiated medical device component suppliers, companies that demonstrably lack Integer's specialized coating tech, or their exposure to those high-growth C&V and neuro markets. Think more generalists, maybe less integrated players.
Ah, so isolate Integer's specific strengths.
Exactly. The plausible rationale for the whole thing. If Integer pulls off the integration of those tuck-ins, if those new product ramps in cardiovascular and neuromodulation deliver sustained, say, double-digit organic growth, and if they start deleveraging even slightly faster than planned, thanks to that strong free cash flow,
then that 15% upside
could prove quite conservative over 9 months. I believe the market will eventually re-rate the stock, shift its focus from a tiny EPS miss to this compelling, higher-mix, capability-rich CDMO growth story.
And the short basket
Acts as a potential hedge against broader medtech market dips, while really trying to isolate the alpha from Integer's specific strategic execution. It's bold, yes, but it's fundamentally a bet on the long game, on strategic foresight, not just the next quarter's numbers.
Okay, so to recap this deep dive, Integer Holdings delivered strong Q2 revenue. They actually raised their full-year profit guidance. That was driven by really robust growth in cardio and vascular and those strategic acquisitions that are clearly compounding their capabilities.
Yeah, but that slight EPS miss and the uptick in leverage, however small, led to that swift, cautious market reaction. It really highlights the current investor focus, maybe even fixation, on short-term perfection.
Absolutely. The company's strategic shift, though, towards high-growth, high-value segments like EP and neurovascular, coupled with disciplined M&A and that focus on manufacturing excellence, it really does position it well for long-term success. No doubt. Investors will be keenly watching execution, though, on the integrations, the new product ramps, seeing if that market sentiment shifts from, punitive to maybe appreciative of this evolving story in the coming quarters.
As always, please remember this discussion is for informational purposes only. It is absolutely not financial advice. We strongly encourage all listeners to conduct their unthorough due diligence. But as you reflect on Integer's quarter, maybe consider this. Is the market's immediate focus on a couple of pennies of EPS truly capturing the long-term value being created by these kinds of strategic pivots into high-growth, sticky medical niches? That's definitely a question worth pondering long after today's headlines fade. Thank you for tuning in to Talk Tickers. We look forward to your insights and questions next time.